Hi everyone, a warm welcome and hello from Rotterdam to all of the international visitors, but of course also everyone who's joining from the Netherlands and from Rotterdam. My name is Laura van Beckham. I'm the Program and Partnership Manager at Venture Cafe in Rotterdam. And yeah, we're very happy and proud actually to welcome you to the very first edition of the Investment Cafe. It's a very new concept to Venture Cafe, and we're going to be running this on a monthly basis. So every third Thursday gathering of the month will be theming the Thursday gathering fully around everything that's related to funding. And we're launching today, so we're really excited about doing that. And we're also very happy to have a couple of partners on board who you will see involved during every investment cafe. One of them is Yes Funded. We're actually about to start a session hosted by them. And also Investeerders Club and Up Rotterdam are involved. So yeah, actually every investment cafe we're going to answer two questions. First one is, how do you fund your business? So we're going to discuss subjects that are related to startups and scale-ups and starting entrepreneurs or people with an idea of becoming an entrepreneur, really to dive into the world of funding and understanding the opportunities you have, the options you have, and learn from experts about it. And the second question that we're going to address is how do you let your money work for you? And this is really something related to a couple of trends that we see around us right now. Also following the crisis, a lot of people have quite some savings in their account, and they would like to know what they can do with that. Think about cryptocurrencies, the stock market, investing in real estate. So that's basically the second question that we're going to answer every month. And I think there's a lot of enthusiasm within the community about both of these subjects, and we're really hoping to help you out and help you in taking the next step with your ID or with your business. So today we're going to launch. We have three main sessions today. First one is the one we're about to start, which is all about the startup funding life cycle, hosted by Yes Funded. And Jan Geert van Hal is the investment director at Yes Delft, and he'll be guiding you through that. After that, we are hosting a panel discussion. So we have a couple of amazing entrepreneurs that are going to share all of their learnings and anecdotes about the funding route and their route to a successful business. And of course, sharing some tips and tricks to all of you to prevent what they've done or to replicate what they've done because it works so well. And the third session is going to start at 6 o'clock, and it's all about cryptocurrency. So we've invited Ömer Akaya, who runs a company called Trades by Akaya, to tell us his view on the world of cryptocurrencies and how he views what's going on right now. There's big dips and hopefully highs again. But more about that later on today. Just so you know, all of the sessions are being recorded today. So if you're not able to join all of them or have other obligations, don't worry, we're going to upload these sessions onto our YouTube channel, either in full or in small snippets. So don't worry about that. And if you have any questions related to informal investments or with regard to Yes Delft or Yes Funded, just so you know, as of 5:30, top of my head, we're going to host an office hours as well. So if you have any questions related to these subjects, feel free to tune into those office hours. Yeah, and then without much further ado, I would love to give the stage to Jan Geert van Hal, who is here as I mentioned, as the investment director of Yes Delft, a high-tech incubator close by to Rotterdam. Hi, Jan Geert.
Hi. Yeah, I mean, it's very close by, although I've seen some foreigners that say, well, we're in Rotterdam, we have to go all the way to Delft in order to, they sort of underestimated a little bit the size of the Netherlands, or overestimated actually. So it's right over there, you can see it. But, yeah. But yeah, we are Yes Delft. We are supposed to be the largest tech incubator in Europe, and we are consistently voted to be top 5 in the world for what we do. So an academia-related tech incubator or incubator at large. We are now like 15 years old, and we actually only started 2 years ago. I will share my screen now. We actually started like 2 years ago with the with Yes Funded, which is more or less the internal investment bank of Yes Delft. And what does that mean? We are a very broad advisor and broker of funding in the larger sense of the word. Two things that we do is actually make us a little bit different from what you see usually. First of all, in terms of equity, there is not much available in very small rounds, which is what we are specializing in. So seed rounds like from 250 to up to 2 million about. And the second thing that makes us a bit different is that we are very much focused on blended funding, and we try to combine all kinds of instruments. Now, this is something that sounds quite logical, but it's also a little bit of a necessity because in the Netherlands, especially early stage funding is not very easy to get. There are large gaps. There was actually an interesting article in the NRC yesterday that highlighted this again. And that has to do with the investment landscape and where the money comes from, and basically the money flows in the Netherlands and in Europe at large. So, but I will go into that a little bit further. So let's go a little bit into. Okay, can I sort of go to the next one? Yeah. So let's go a little bit into the different forms of company funding. Very general, you could say there are simply dilutive and non-dilutive funding. The non-dilutive one actually is the one that you don't basically sell part of your company, and the dilutive ones, of course, when you sell equity in the company to somebody else in return for money to run your company with. Now, there is, in terms of non-dilutive, there are two main forms. One is in the forms of loans, and the other one is in forms of grants and subsidies. And mainly these kind of instruments is what you see, what's used in very early stage. And I have to say that most of the companies, even if they are very, very early stage, come to me with the question, can you find an investor for me? Which they usually mean is that I have to find an equity investor for them. And it even went so far that I had a discussion with a very, I wouldn't even say early stage. I mean, the guy had like an A4 with a blueprint, what he wanted to do. And he was actually pretty unimpressed by the fact that there were not 100 investors lining up to give him $1 million for this. In the end of the day, I sort of had to explain a little bit how the funding landscape worked in the Netherlands, and he was like, "Okay, well, being an entrepreneur is much harder than I thought," which is I thought was quite hilarious. But it also gives you a little bit of a flavor of what people perceive as with their early stage startup, and what's actually the reality in the Netherlands. And there is, of course, a lot of talk about opportunities in terms of equity funding and large tickets being paid in the US, for example. I had a call with Convertibles, which is a large angel network, 2 weeks ago, I think, and we went through some cases that were comparable to the startup we were working with at that stage. And yeah, I have to say, I was like, okay, what the heck am I doing here? Because these guys got big tickets against quite reasonable valuations for startups that were actually not even in revenue, which is something that you cannot really do in the Netherlands or in Europe. So let's first go through a little bit through the non-dilutive stuff, and let's get the bank stuff over with. Banks have a very bad reputation after 2007, and I also have to say that if I look at the statistics, especially small and medium enterprise funding by banks has pretty much collapsed after 2007. But you also have to understand that banks do not really have an upside in funding. Now they can do three things. That's one is collateral secured. Basically means that you can offer your house, your wife, your goat, whatever you have as a collateral for a loan that you will put in your company. It's a little bit not done in terms of theory, but it's happening actually all the time. So I wouldn't really bother to say, I mean, this is a no-no. In the end of the day, it's something that happens every day. So not much around it. The other thing is cash flow secured, but that basically means that you can actually go back to the old saying that you will get a loan from a bank if you can prove that you don't need it. So yeah, you have to have cash flow in order to positive cash flow in order to get the loan. It may sometimes work if you really want to increase slightly your speed, but on the other hand, yeah, you need to give a lot of securities, for example, that a bank will more or less govern your credit and your debtors, which is not really something that you want to do. And the other one is asset security. Now, this one is actually, even for startups, a little bit more interesting and something that's a little bit overlooked, because now we are, of course, yes, Delft. I mean, we are hardware, meaning that we also buy machinery and stuff. And it's a little bit of a pity if you use equity or funds provided by equity investors for buying a lithography machine, for example. And we did actually a few projects where we simply leased that, and we have a simple case, for example, where we indeed we needed a few lithography machines and some other stuff that was pretty much, I wouldn't say off the shelf, but also not that rare, and that was like 350,000 euros or something, and that took like 5 minutes to do, because it was machinery from suppliers that were trusted and well known, and B, it was below 1 million. And actually, the bank, they told me that if it's below 1 million and it's a trusted supplier, they don't even look at it. I mean, they simply push the approve button. So that's something to keep in mind. Even for startups, this main interesting sort of additional funding within your whole project, that you say take assets out and try to get a financial lease for that. We are actually running now, I think, 2 or something projects where we actually are looking into it. Now let's go to the public funding, and most of the early stage startups, they will be familiar with subsidies and grants. Is it free money? Yeah, it is at the end of the day. You have, of course, obligations. You have to write reports, but in many cases, it's not that hard if your administration is up to speed and up to par. I mean, it's not a real issue. But one of the things I have found out over the years, and I've been CEO of a company who was actually pretty bad at this, you have to really apply for grants that really fit in your roadmap and your strategy, and don't go after the money just because the money is there. We have a sort of a saying that these guys who do that, we don't call them entrepreneurs, we call them grantpreneurs. But I've also seen companies sort of getting really distracted, especially when they participate in large consortia that also contain TNO and universities and blah blah, all kind of stuff. And the whole thing, first of all, goes much slower than they would actually like to go. And secondly, if they want to pivot or sort of go somewhere else because the market demands it, the project parameters simply do not allow it to do that. And that's the last thing about free money. Yes, it's free money, but in most of the cases, you need to show that you have actually some money yourself. I mean, the funding is not 100% of what you're actually proposed to do. So you have to show that the remaining of the money actually, you have that secured. And it even went as far as one of my own companies. We did the Eurostars, and I actually had to provide, I think, a print screen of my bank account in order to show that I could basically pony up the other 50% of the investment, which was a little bit far-fetched, but it gives you an idea that you have to show that if the subsidy is like somewhere between 30 and 70% for example, ESC, that the other 70 to 30% you are able to provide it yourself. So no free lunch there. There's, of course, a lot of different subsidies. You have to be aware that subsidies are public money. So they follow the policy of the government that's in charge. They want to stimulate certain things. It has to fit. It has to fit in there. no way around it. I mean, that's not more than logical. Another thing is, of course, that the government, yes, they give you the grants, but there are World Trade Organization rules that state that if you get closer and closer to the market, that the subsidies will be lower and lower. Now, there is one exception, actually, which is a bit funny, because it's the European Commission, the famous ERC accelerator, the European Innovation Council. And since the EU is actually of the opinion that since they are not a country, they are not that held that way to World Trade Organization. So, rules. So, for example, the ERC accelerator is a 70% subsidy, which is a lot for companies who are actually already making revenue in Mexico in most cases, which the Netherlands would never be allowed to do that. But the European Commission gets away with that. Of course, it's very much for specific groups or of companies. You always have to check the eligibility criteria. Do you comply to that or not? The good part is that most of you guys will have a small and medium enterprises, which is usually defined by less than, I think, 250 FTEs, 50 million of revenue, and 50 million of balance sheet total, whatever comes first. So you will be in that bracket. But in many cases, for example, you also need an S&O declaration. So basically, you need to have WBSO or to be innovative, or another way, sort of being earmarked of being eligible for that kind of thing. I've seen a few stupid mistakes where companies got an investment by a larger company, even by multinational, and due to let's say proportional consolidation, they were not considered a small and medium enterprise anymore, so they were not eligible for any subsidy whatsoever anymore, which is something that you really have to be aware of if you partner up with a larger company or get an investment of a larger company. Another thing in subsidies, success rates are pretty low. The highest I know, actually, I think is Eurostars, which was always like 30%, which is actually very high for a subsidy. The lowest one is, again, this famous ERC accelerator, which is, I think, in the last polls of the previous scheme was down to like 2% or something. So please don't base your whole funding plan on acquiring a certain subsidy, because just do a lot of things at the same time in parallel. Another thing is, of course, that it may actually take quite a long time between the start of the application and you getting the money in the bank account. And there are some examples again here. Eurostars, I think that typically if they have, for example, the call in September, where you have to submit your proposal, and you would probably get green light somewhere in December, and then you have to do the Dutch application lag, and then you may actually get your money around April, something. So, I mean, take that into account, anticipate it if you want to go for this scheme. Well, the last one on this, do you need a consultant? Because there's a lot of grant writing around, and actually we do it ourselves. We have a partner for this. I have written myself a few ERC accelerators in my life, simply for companies that were too large for me to invest in myself, and I said, okay, let's go and help you with it. It needs sometimes it needs very specific lingo. But it's not always necessary, to be honest. In certain cases, it's okay. What I always advise in this case, get somebody who works on a success fee, preferably only success fee. It's not always possible, but at least you will get a honest advice, because these persons have skin in the game in that case. I mean, if you don't succeed, they get nothing. And they will advise you right at the start whether it's actually something achievable or not. If you work with a retainer and that basically covers the cost for them to write a proposal, they will always tell you to apply for it, even if they know you don't stand a chance in hell to get it. If you work with somebody who only gets money if you succeed, I mean, you will get you a much more honest opinion on your chances in the specific instrument. Now let's go to the last one, to the equity. Everybody's been waiting for or not, I don't know. But the first thing I always do when an investor approaches us, and that happens quite a lot in yes, Delft, fortunately. I want to know whether these guys invest their own money or somebody else's money. And that's important because, as I said before, the capital market in the Netherlands is a little bit different from the US, to say the least. And the thing is, you have to understand that the funds, the regular VC funds, they are funded by money. That's not, of course, from the investment managers that are in the fund. They have a prospectus, they go to pension funds and they say, look, I mean, give us our money, we're going to invest it in the tech startups. Now, there's already immediately a sort of a lingo difference, which was actually interesting. I was in a sort of meeting with Patrick Polak, who is the managing partner of New Investment, one of the larger funds. And he was saying, yeah, these rounds getting smaller and smaller every time. So, I mean, nowadays in a seed round of 2 million, I mean, you have the A round and 10 million. And I mean, just to sort of show off a little bit, and the smaller rounds get pre-seed. And he's actually saying, so now we're actually at New, we only do a pre-seed round. And I was like, yeah, but Patrick, you're still bound to your prospectus, which actually means that you cannot invest in companies that have less than 50,000 euros a month recurring revenues, almost $1 million a year. Now, to the startup community, to us, that's a scale up. That's not a startup anymore, and especially not pre-seed. If we are talking about that kind of terminology, for us, that's pre-revenue. And you have to understand that these regular VC funds, they cannot really invest in pre-revenue startups, which was again highlighted yesterday in the NRC article, basically saying, look, I mean, you can get an investment if you have a SaaS platform that's completely de-risked, and you have no hardware, and you have a nice recurring revenue, and then everybody will be in there. But if you're not in that space, it's pretty hard, and that's something that we experience every day. But the guys invest in their own money, they can pretty much do whatever they like, of course. So what are they looking for? Usually shorter term milestones. They look very much into your burn rate and your length of your runway, and when are you going to be break even? How are you going to spend the money? Don't buy a Tesla. Give yourself a reasonable salary, but don't overdo it. All these kind of things. They of course know the business because they like it. They have some sort of passion, so they can sometimes invest a little bit earlier than the funds. But to be honest, what we see in the market, they are not that much earlier than the regular funds. There are a few exceptions that do mainly pre-revenue investment, but there's not that many of them, to be honest. And some things you have to be a little bit aware of is that we see a lot of shareholder agreements that are, a little bit, let's say, amateuristic. There, of course, it's a little bit of a free flow kind of thing. With the funds, they usually use a template. That's all fine. But with angel investors and guys doing their own money, it can go anywhere. You have to really be aware if it's a first investment. If you don't end up with a shareholder agreement, that sort of blocks anyone else going into the next round. So that's one of the things you really have to be aware of. Now, the guys investing somebody else's money, they basically look at two things. Is there a long-term opportunity? Is this product really going to fly and going to be something big in the future? And two, is there a team that actually can make that happen? If that's the case, then money isn't really an issue. The thing is that the funds are there, of course, very much for a financial return. That's the only thing they really care about, whatever they say about being so involved in your business. So, I mean, basically all the funds say that. But also in a different meeting, again, Patrick Polak basically said, look, I mean, basically on the back of an envelope is that, look, I mean, the way it is, we get 100 million from the pension funds. Now 2% goes to us for the fund management, for the salaries and so. 50% of the startups don't make it. 30% will do break even. 20% has to make the money. Now there is an IRR per year of about 20% on the money. We have to do an exit in 7 years. So you figure out how much money these 20% has to make in order for the fund to be a success. I mean, that's basically there. So that's what makes me lie awake at night. Nothing else. I mean, how to get that return back in 6 or 7 years towards the pension fund. That's basically it. So they very much start trying to get in low, trying to exit high, and they just stick to what they know. And the operational execution power of the team, that's key. I mean, are these guys going to make it happen? There's new stuff going on, of course, in the from straight equity stuff, which is convertibles. There's also nowadays some American stuff in terms of easy repayment on shares and safes and so, which are more or less convertible notes without the repayment part of it. They are nice for early stage startups, but most people tell me, look, I mean, I'm going to do convertible because I don't really have to care about the valuation then. Now, that's true, sorry. Because all these convertible note agreements, they have a sort of valuation cap. So money cap, which basically means that you still have to do a valuation because you have to kind of make a very good estimate of the valuation that will be valid when you do the round that triggers the conversion. Otherwise, you will lose a lot of shares. I once seen a very extreme example where there was actually I think a 100K convertible note that had I think a 1 million cap. But it basically meant that the whatever would happen, in the conversion, the guys who gave the note would also always get at least 10% of the shares. Now these guys were actually trying to do a round of 10 million valuation, so that would actually mean that the guys who did the convertible note would get a 90% discount compared to the new investor, which wasn't really nice. And it all goes to the expense of the founders, because these guys basically have to pay in shares for that kind of silly mistake. So be aware that you have to, if you do a convertible note or a safe or an apples, you have to have some idea about where the valuation will be when you are doing your next funding round. But that's all fine. There's a few other things that you can change there. What I usually do is when I have a startup, I usually get a template for a convertible note. I simply kick out the cap, and I sort of set the trigger, let's say the option right at the startup. Basically means that the startup can decide whether the conversion takes place or repayment takes place. And then it's up to the investor actually to turn that back around towards the template. But sometimes you get away with it. You get a much more startup-friendly contract. There's one exception that's unique. They don't have a cap, and they have default the conversion, the option right at the startup side. So sometimes I simply take that as an example and show it to an investor and say, look, this is normal, and you get away with it sometimes. Now let's get a little bit to, okay, where does this all fit? If you go to the very early stage, there's all kinds of savings with families and friends, and you have some, I have a cursor. Now you have some RVO instruments that are pretty small, and some proof of concept funds like Unique here, and that more or less goes to TRL 7, and you have some pilots here and there. That's also the point where more or less the Dutch government has to bail out, for the simple reason that with TRL 7 and a few pilots going on that may or may not be paid, I mean, you're pretty close to the market, and you get into the area where they might be accused of government support of industry, which is not allowed. But at that point, you get into this famous valley of death, and that's the point where you have indeed your MVP ready. So you have some interesting product there, and you have some interesting pilots that may even be large customers. And you want to do two things. You want to mass produce your product, and you want to capitalize on the momentum that you have with the pilots to set up a sales organization and sort of roll that out. Now, these two things cost a lot of money, and at this stage, there is nobody home, to be honest. And this is the big thing, also what the NRC was writing about yesterday. Now, once you get into the part where you actually make interesting revenues, and so you get here into the venture capitalist, then you're done. I had a discussion with Corné Janssen, I think last year in the Philips Innovation Award Investor Day, and I was sort of explaining this and said, look, I mean, these guys of INCAF, and so there's nothing they can do for you, because I mean, they need this revenue. And Corné was like, yeah, I mean, he was like, yeah, I don't like you to say this, but you're basically right. There's simply two things. If you have less than 50K of revenue, simply don't call us. We're not interested. If you're more than 50K of revenue recurring month, don't call us either, because we will certainly find you. So yeah, I mean, that's kind of the bottom line of how this works and why there is this big gap. Again, this ESG accelerator is a sort of a strange phenomenon, because that's a large subsidy, and nowadays also with equity supplied on top of it, maximum 50 million. That's in that gap. There's a few other things like the BNKB and the innovatiekrediet, but they're pretty hard because you have to do a lot of matching and to do a lot of blending in order to make that work. And once you're like here, I mean, yes, you're going to scale up, and there's all kind of funds available. I mean, all the funds tell me, okay, once you're here, there's so much money in the market. I mean, we can't really sort of get rid of it. It's impossible. That's also one of the things why I'm kind of miffed that, for example, InvestNL is also in this space instead of in this space. And they're actually put all this government money in the space where there is already enormous amounts of private equity and private money available. So that's a bit of a missed chance in my opinion. But yeah, I mean, it's the way it is, and it has to do with where the money comes from in the funds and a little bit of risk averseness let's say it's a bit like defensive money. That's simply the way it is. It's not going to change, unfortunately. There's a few new things that we're doing. We're exploring last year about fractional ownership, which makes it much more liquid in order to invest. So you could actually tokenize your whole company, and people could invest from like 10 euros onwards. That would cut out middleman, and you don't need notary for all the transfers, and so and you can actually execute the whole thing by smart contract based on milestones. And so we were trying to set this up. For Delft, it wasn't easy because we have public shareholders, and of course, I mean, this is something that's a little bit far out for them. I know that Hightech Excel in Eindhoven is fundraising, John Bell and his team, in order to get a fund like this. But it's also not easy for them because structurally it's not a traditional fund, and the pension funds, they say, look, I mean, we can do fund of fund, but we cannot invest in this because we don't know the legal format. So it's getting there. Let's hope so, but right now, not very easy, to be honest. This is a bit what I run through. I see there's quite some stuff in the chat. I'm not sure whether there are questions in there.
Hi, Jan Geert. Thank you for the presentation.
I also have no clue about the time, but it's probably like okay-ish, I hope.
Yeah, we're running a little bit over time now, but I had a lot of introduction, so it's not entirely.
Yeah, it's your fault.
No, we just recommended because there are indeed a couple of questions, but I think the answering them will take some time, and I think it's
we
nice
can do it in the office hours otherwise. I mean, so yeah, I'll be available like, what is it, 5:30? Yeah.
I do
Yeah,
see.
that's what I explained in the chat. We can just answer all the questions that you have in our office hour, both about Yes Delft and Yes Funded. So just meet us there and we can answer everything.
Yeah, I do actually have an external office hour that people can book. That's on the website, the Yes Funded website, which actually get a lot of traffic from all over the world, which is interesting. Yeah.
All right. Yeah, that's a great
You
recommendation.
can simply push a button like book a half an hour with Jan Geert, and somewhere on Tuesday afternoon works. Yeah.
Yeah, perhaps if you have the link to that office hour booking tool, you can post it in the chat. Otherwise, it's on the website, I assume, of Yes Delft.
Yes, it's on the yesfunded.nl website. Yeah.
Okay. All right. Thank you again, Geert, for demystifying the world of capital a little bit more.